Welcome to our class in MCM, Money and Capital Markets. So we're going to look at issues to do with inflation and how it affects economies. So this question reads, Zambia, a net importing economy, has experienced significant macroeconomic turbulence. A monetary expansion policy under the floating exchange regime contributed to the hyperinflation and currency crisis. So using a map, which is a monetary approach to balance of payment model with illustrations, evaluate how this monetary expansion have led to Zambia's currency problems and explain how Zambia is affected by the inflation development in the US, given subsequent adoption of US as a primary currency. So we must understand that when Zambia is deemed to be a net importing economy, it simply means what? Heavily reliant on what? Foreign goods and services. And the past reliance on these monetary expansion policies under the floating exchange uh, regime or rate actually triggered hyperinflation. It also triggered currency depression and also loss of some investor confidence. So to stabilize the economy, Zambia had to partially adopt the United States dollar as what we call the domestic currency. This is what we call dollarization. So there's what we call the MAP, which is a monetary approach, balance of payment. It is a model which simply views the balance of payment problems as a monetary phenomenon, which is actually caused by a mismatch which occurs between the money supply and the money demand. So when you have a situation where money supply is excess, means that we have so much money in the economy. This is what leads to what? Inflation. When we have current account deficits, when we have capital flight is where we have investors who withdraw their investments because of instability in the economy. Okay, and currency depreciation. So we have also seen, I mentioned the issue of dollarization. Um, so we, as a country, adopted the US dollar um, as our base currency. Okay, so the adoption of this US dollar actually makes Zambia very vulnerable to the inflation rate and the interest rate policies. So our country sometimes it loses its independence in the monetary control, and it limits our ability to respond to the shocks depending on how the dollar is performing. So there were some foreign exchange market interventions through the central bank that were used to defend the currency. So some of the interventions we'll look at in the next question, um, unsterilized and sterilized inventions. Okay, so now we need to answer the questions with that background. Okay, so I've just given you just some background of you understanding the concepts. So question 15, so want to answer using the map model with illustrations. Let's evaluate how the monetary expansion may have led to Zambia's currency problems. So to start with, the map explains the balance of payments or a disequilibrium in the primary monetary issue. This is when money supply is growing faster than the demand. So this phenomenon would actually lead to number one, increase in money supply, where we have more money facing or fetching fewer goods. So the application that it has to Zambia is that the Bank of Zambia had increased the money supply through what we call the expansion through what we call the expansionary policies. So when money supply exceeds the public demand for money, people will spend more on goods and on foreign currency. Okay, then there would be capital outflows, which would be due to low interest rates and uh, capital account deterioration. It will also lead to a combined uh, uh, mix of these problems above. So we are trying to use a map approach model to illustrate how the monetary expansion may have led to currency problems. So I've just mentioned to say Kwacha. After Kwacha, the crisis, Zambia increasingly relied on the US dollar in all its transactions, like it was a partial dollarization. So this arrangement, Zambia was strongly influenced by the US monetary policy and inflation trends. So we had to import inflation. So if the prices in the US will raise, so it means our import prices will also increase, mostly because we were invoicing in dollars. So for instance, if the US inflation would rise in the price of machinery or fuel, it would mean Zambia will have to pay more. The second implication of this one would be in the loss of monetary independence. So Zambia could not print US dollars or could not control its supply. So it will lose its ability to set its own what? Interest rates or to adjust the monetary supply to stabilize the economy. The other implication is that what impact will it have? The impact of the US Federal Reserve policy. So if the Federal Reserve will increase the interest rates to fight the US inflation, so it would mean that the dollar, uh, if it strengthened globally for Zambia, it would mean there would be high cost of dollar dominated debt, meaning debt servicing burden will increase. The other implication would be that there'll be increase in the cost of imports like fuel, medicines, and machinery. And Zambia could not also counteract these shocks through its own domestic policies because they are depending on a foreign currency. So I'll give you an example so that you understand more the application of these references I'm giving. So in an instance, for instance, where if US has a 5% inflation rate and the federal government will raise its rates, the dollar will strengthen. So here, what will happen is that Zambia will now have to use more kwacha to obtain the same amount of dollars, or will have to start pushing local prices higher, even if Zambia's inflationary pressures are low. So dollarization, in short, actually makes Zambia very vulnerable to external shocks. Of course, it helps to stabilize transactions and avoid hyperinflation from being excessive in terms of printing more local currency. It actually exposes the economy to the US inflation and the interest rates, and there will be little room for domestic policy response. That would be the implication. All right, so you need to understand more of how Bank of Zambia works. Then we looked at this question some time back, discuss how the central bank can use both sterilized and unsterilized foreign exchange market interventions to prevent its currency from depreciating, ensuring that you differentiate the impact of each method on domestic money supply. Right. So to start with, when we're talking about the foreign exchange market interventions that occurs within the central bank. The central bank will buy or sell foreign currency under its management to influence the exchange rate. So when the domestic currency is under pressure to depreciate, where there is too much demand for foreign currency, the Bank of Zambia can use two main ways that the intervention. So we have what we call the unsterilized and sterilized invasions. So I discussed this in my previous class. So, who can briefly give me an explanation of what is meant by unsterilized interventions? Who can explain what it means, unsterilized interventions? So, in talking about, I mentioned this, the unsterilized interventions are simple interventions where the central bank will sell the foreign reserves, like the US dollars, in exchange for domestic currency, like the kwacha. So, in essence, when we in Zambia have our kwachas out there where people would want to, when you go abroad, for instance, you'd want your kwacha, it may not be recognized forever. So you would have to change it, maybe in the US to get US dollar, in Japan to get the yen. So the Bank of Zambia, through the central bank, would use as sterilized interventions in wanting back the kwacha instead of printing that kwacha, they'd want back their kwacha. So they'll need to have enough what? US reserves in exchange for domestic what? Currency. So this will reduce the supply of kwacha in market because when we're young, we'll just ask, hey, the government prints money and we are broke. Why don't we just print more money and more money? And we get to solve our problems. But that's not how the open market, the OMO system works. It's actually, we have foreign currency that is dirty, like Malawian kwacha. You can't use it. So our government will go to Malawi and say, we have your kwacha, give us our kwacha as well. So even with the US being a currency that is on demand, so we use that same currency to fetch our own money. So this is what we call the unsterilized intervention. So this will reduce the temptation of the government printing out more money, which will lead to inflation. So it will reduce the supply of the kwacha in the market because the public will now will hold fewer kwacha and more dollars. So the effect that this will have is that number one, on the exchange rate, the kwacha will strengthen. Okay, it, it will reduce in depreciation in short. Secondly, we're going to have an impact of money supply. The domestic money supply will shrink since kwacha is withdrawn from circulation. So the drawback that may come is that there'll be prolonged use of there'll be high inflation, high interest rates, and slow economic growth. So I'd give an illustration where the Bank of Zambia will sell 10 million US dollar reserves. This will actually mean they want to absorb kwacha back. Okay, so it will reduce the money supply and will stabilize the value of the kwacha. And we also have what we call the sterilized interventions. Sterilized interventions are ways in which the central bank will sell foreign reserves to buy domestic currency. So it's like the opposite here. So the sterilized interventions, this is where the central bank again will sell the foreign reserves to stabilize the economy. So they will have to neutralize this contraction of money supply. So they will conduct it by offsetting this operation. Usually, they'll buy government securities like the bonds, the treasury bills, mainly in the money markets. So the effect that this will have, number one, on the exchange rate is that the kwacha will still strengthen where the currency will be defended. And in the money supply, we have a neutralized overall liquidity in the economy. It will remain unchanged. So the benefit that we're going to have from here is that there'll be stabilized currency without actually affecting the interest rates. So the difference basically between these two, sterilized and unsterilized, number one, on the effect of the money supply. So the unsterilized will reduce liquidity, to tighten liquidity, whereas the sterilized will be neutral. This will actually be offset by buying of capital market instruments like the bonds. The other difference will be on the impact on domestic economy. So if you're using the unsterilized intervention, it will cause a rise in interest rates and it will slow the growth. Whereas if you're using the sterilized interventions, there'll be minimal domestic impact. And in terms of sustainability, if you're using the unsterilized interventions, there'll be limited for foreign reserves can actually run out. Whereas if you're using the sterilized interventions, it's more sustainable, but maybe costly. Okay. Then discuss the functions performed by the global financial markets and outline the key services that are widely sought by public and corporations. So this is usually question number one of your exam paper. It's actually been repeated several times. What are some of the functions of the global financial markets that we talked about? So the global financial markets basically are platforms where the borrowers and the lenders, as well as the investors, are interacting across borders. They serve as a backbone for international markets or international financial systems. So the global financial markets are there to bear risks, to provide information, and also to ensure that there's efficiency. The main function, we actually came up with the formula of the financial global financial market. So we talked about capital allocation. In these financial markets, they were there to connect surplus units with deficit units. So connecting the savers to the borrowers. The financial markets, in terms of capital allocation, are there to ensure that households and corporations and governments that have excess funds or capital are directed towards productive investment areas like infrastructure and manufacturing. For instance, we have a euro bond or a global bond market that will allow Zambia to raise funds from the international market. The second important role is that of risk transfer and management. So it is in these markets where there's a provision of mechanisms like the derivatives, where we have swaps and futures. These ones will help investors and corporations to hedge against what? Uncertainties. So risk management. Price recovery, discovery is another function of these global financial markets, in that through these forces of demand and supply are there to help determine a fair price of these instruments, like the bonds and the stocks. So it's there for price discovery. So prices in these markets will reflect what? The available information. And it's also a liquidity provision. So it's these global financial markets that enable participants to quickly buy or sell assets, making the financial instrument convertible into cash with minimal loss in the value. It's also there to facilitate international trade. So the financial markets will provide what? Credit and foreign exchange services that will make cross-border trade more possible. Now, what are some of the key financial services that are sought by the public and corporations through these markets? What are some of the key services? So we have services like banking, insurance, investment services, foreign exchange. So these are the main services that are sought. So when talking about banking, you're looking at individuals, corporations, individuals like you and me who deposit accounts, credit cards, personal loans through these mechanisms. Corporations also working capital financing, trade financing, project loans, all these processing are done using these platforms. So they provide banking services. Secondly, they are there, the services being sought are insurance services to protect against any financial losses. So if you want to order a car, there should be an insurance company that will be there to bear the risk. So insurance services. Other services that are being sought are services like what? Investment and wealth management. So there are brokerage services for buying and selling securities like bonds. There are asset management and mutual fund services that are there. There are advisory services. All these are seeking to give you options that are feasible and best. Then also there are foreign exchange services. These help facilitate converting um, cash in one denomination to another. Corporations will use foreign exchange services to hedge against what? Exchange rate risks. For instance, if you have a Zambian exporter of sugarcane, they will use forward contracts to secure the dollar revenues and avoid losses in the kwacha. Then these markets also help in capital raising and corporate finance. So companies will access equity markets where they will sell shares or the debt market where they issue bonds to raise long-term investments. And the other services are mainly for payment mechanisms and settling of debt. So the global financial market will facilitate electronic transfers, mobile money. We talked about the fintech world the other time. So these are the functions. So you must realize that this question will come in different contexts. So you must understand the key role that the global financial markets are playing. So in almost all the papers we've been having that question. All right, so let's go to our calculations now. So question number 18, we have, let me put it on my clipboard. We have a 3-month TB with par value of 10,000, which is selling for 97. Compute the discount rate. This is now song of the moment. So how to calculate the discount rate and what are we given in here?
So, okay, I can identify what we are given.
Okay, please go ahead. What are we given?
So we have the face value, which is 10,000, and then we have the 10,000 kwacha.
This is a face value,
Face value of, yes, then that one, the 9,000, it's the purchase price, the selling.
This one is a what?
The purchase price, yeah, it's sold for
Purchase price?
purchase price.
Uh-huh.
Yes. We are also given the N. Is it the N or time?
The
3 months, which is like 90 days. Mhm.
Uh-huh. Yes.
Yes, I think pretty much. Then now we can compute the discount rate.
What's the formula for discount rate? Anyone who remembers the discount rate formula? Small d is equal to what? The face value.
The discount is equal to face value minus purchase price over face value.
Yes, the key thing is face value here. People make a mistake on what to. Times what?
It's going to be times 100. Oh, is it?
360 over n.
Mm-hmm. So here is 10,000 minus what? 97 over 10,000. Mm-hmm. Times 360 over what? Time. What was our time? 90. You can put times 100 if you want at the end. So this will give us our discount rate of 12%. So our D is equal to 12%. Are we together? Okay, so how do we find the money market yield for a commercial paper with a nominal value of 100,000 at an interest rate of a discount rate of 7.5%? How do you find the money market yield? Anyone? This is
Okay,
revealing.
so the formula that I have here, it says D, which I believe is discount,
Mm-hmm.
over P,
Mm-hmm.
over P times 360 over T. Is this the correct formula?
The formula for what now?
Money market yield.
The money market yield. Okay, correct.
Yes.
It's what?
Oh, I said it's D, which I was saying I believe it's discount over P, D divided by P times 360 over T.
It's supposed to be the par value minus the issue price over issue price times 360. Remember, money market, you have to, it's the most complicated. You have to calculate it after calculating the issue price.
Okay, okay.
Okay, somebody else to try, or start with the issue price. Very money market yield. I want you to remember this formula. It's like there's been we've been too quiet. We've forgotten our formulas. So money market yield is what? Par value or face value minus what? Issue price over what? Issue price times 360 over time.
I think I have another formula here. Mhm. Then
But we need to
over days
find,
to maturity. Mm.
so we need to calculate the issue price. How do you find the issue price? Issue price for commercial paper, face value times 1 minus D times 360 times time over 360. What did I say? What's the formula for the issue price?
You said what?
Issue
You said
price,
face value
uh,
times 1
face value.
times 360 over.
Face value times
Mm-hmm.
in brackets 1 minus
Mm-hmm.
r r times t over 365 or 360.
1 minus RT
R times yes
over 36.
365
Yes.
or 360. I don't.
Yes. Yeah. So you remember I taught this. Okay. So what is um our face value? 100,000 minus what? 1 minus 7%, 7.5, 0.075 times time is what? 60
60 days.
over 360. So that we get our issue price. So our issue price, when you calculate it well, it will give you the figure 98,750. So what do you do with this 98,750? which is what will come here, right?
Yes, you replace it in the formula.
So 100,000 minus 98,750 over 98,750 times what? 360 over what? Our time, which is 60. So if we calculate that, we're going to get our money market yield as a percentage. You can multiply by 100 if you want at the end. So this will give you our money market yield of 7.6% or 7.59 to be precise. So all these are examples directly from your textbooks. So most of your exam questions are just the examples in your textbooks. All right. So these are the computations. Anyone behind? We are all together. Okay, then can somebody give me the procedure of the procedure for a banker's acceptance? Banker's acceptance. What are the steps involved? Can you hear me? What are some of the steps involved in the banker's acceptance? Am I audible?
We can get
Yes,
you.
yes,
Hey,
can hear you.
give me the steps involved in banker's acceptance.
I
What's the
just remember that one, there's mutual, I'll say one, then others will also say some. There's mutual agreement between the seller and the buyer,
Okay, so I'll give
which
you
is the mhm.
5 minutes homework to write on the group the steps quickly. So we end here for now. Thank you so much for your time.